The greening of Germany's financial sector, lessons from Europe. That sounds like a book that you might pick up on the marketplace level a little bit further down in the Kappa Europa. But it is actually our next panel, our first panel. And there's a lot of pressure for this first panel to really deliver the goods. Just trying to scare you. You'll be fine. But the whole idea is that what can Germany learn from Europe? What is the knowledge sharing that we can actually share from Europe into Germany, Germany vice versa? Are there still things that Germany could learn? Alzbeta.
Absolutely. Thank you, Femi.
Alzbeta Klein is the director and global head of IFC Climate Business. She's a very important person. Enjoy her and her panel.
Thank you, Femi. 5 to 36%, we all remember, and someone had to pay for it. So this panel will tell you who paid for it and what we are going to pay for in the future. So let me welcome on the stage Michael Schmidt. He's a member of the board of directors of Deka Investment and member of the EU High-Level Expert Group on Sustainable Finance. Michael? Dr. Karsten Sach, who is a Director General for International, European and Climate Policy at the Federal Ministry for the Environment, Nature Conservation and Nuclear Safety for Germany. And also he's been a climate negotiator since 1999. Welcome, Karsten. Next, we've got Olaf Sleijpen. Olaf is a director of the Supervision Policy Division at the Dutch Central Bank, and he's responsible for financial supervision, and he's also a part-time professor at the Maastricht University. Olaf? And we've got Melissa McDonald, who is the head of Equities and Investments at HSBC Global Asset Management UK. Welcome, Melissa.
Thank you.
And we've got Dr. Joachim Nagel, who is a member of the executive board of KfW, and he also served at Deutsche Bundesbank. Welcome, Joachim. So with this impressive lineup, we've got about 50 minutes to talk about greening of the financial system. Financial system today delivers between $5 and $7 trillion every year to finance what the minister was talking about, to finance renewable energy, to finance sustainable agriculture, to finance green buildings, and many other areas. We have seen pressure from the shareholders who are asking for more and more in this space. And we are seeing regulators who are stepping into that space as well. And we are seeing credit rating agencies coming on the scene as well. The concept of green finance is fairly new, but extremely important if we were to make a difference in greening our financial system and greening our economy. So in this panel, we will try to understand better what green finance is, where we are today, and where we are going to take it into the future. So with this, I would like to turn to Michael first. Michael, you have worked in this space for a while. Tell us, why is it important to focus on green finance, and what is the impact of green policies on investments?
Well, thank you, Alzbeta, and good morning, everyone. As the Minister already alluded to, the financial sector has an important role to play here, simply because it is the space, the sector where assets are gathered, where capital is accumulated, and capital is allocated. At the same time, there's also a multiplier function of the financial industry. We know money creation and money multiplier effects. So with that as a background, it is clear that the financial industry plays a crucial role in bringing the capital that is around and is abundant at this point in time. When we look at German savings, for example, more than 2 trillion sit on deposit, short-term deposits or savings products, and to those that need the capital for developing innovative projects to actually achieve what we ought to achieve when we want to actually get to the goals that were set out in Paris. Mm-hmm. And investors in particular have an important role to play because they also take fiduciary responsibilities for others, and that comes along with rights as equity owners, as shareholders, and those rights should be executed in a responsible manner. They should not sit idle in in funds, and therefore stewardship becomes a very important notion here. But eventually, however, the financial sector cannot solve it on its own. There needs to be policy coordination, policy consistency across many sectors. The financial sector can allocate capital, but the change in products, in services, in projects needs to come in the real economy. We can't change the products that consume resources. We can't change the products that emit CO2. That's the companies or the consumers that are required here. So that's why also in the high-level expert group final report, we highlighted this need for a policy coordination and to avoid contradiction of policy signals, to avoid price signals or fiscal stimulus that actually goes the other way, or financial regulation that focuses on the short term, whilst we need long term. But we also need to change, and that's the view into the financial sector itself. We need to change culture and behavior in the financial sector such that the awareness becomes greater of those long-term transition risks and opportunities. So it's really a crucial role the sector has to play, but it needs to be well interconnected with all the other players there are.
Thank you, Michael. So you mentioned something very, very important, which is multiplier impact of the financial sector. If you want to get something done, you can do it on your own balance sheet. If you want to amplify it, you do it through the bank. So that takes me to Karsten. Karsten, it would be great to hear what Germany has done to green its financial market, especially because of what we hear from the minister, from both government representatives about the role of Frankfurt as a financial center. What is it that Germany is doing to green its financial market today?
Thank you, and good morning. Let me start with Paris. What does Paris tell us? We largely need to decarbonize our economies by mid-century. And secondly, we need to align finance and other politics according to these goals. So we think that we are somewhat lost in translation so far. So to give the signal loud and clearly to the financial sector who has an interest in spending money wisely and making profit with their investments. Therefore, the first step, and I agree with Michael, is with governments. That's why we set up, as one of the first countries in the world, what we call a climate action plan, a climate change plan 2050, which basically defines the steps we as a society have to undergo by 2050 in order to be compatible with the Paris goals. And that entails targets for 2030, 40, 50, so that the perspectives for each and everybody is quite clear. We said that it's not just the environment ministry could do that. Michael was talking about policy coherence. Everybody should contribute. And therefore, we have clear-cut sectoral targets. And now the translation aspect steps in. We see that the German Federation of Industry is modeling now for the first time, because we make them actor, a minus 95% scenario. You see suddenly the financial city of Frankfurt and all hubs in Germany being interested in creating mechanisms like the Hub for Sustainable Finance or the Frankfurt Sustainable Finance Cluster of how to do that. And we're working on two different levels. The first one is creating transparency and creating just the mechanisms for the financial sector to be able to understand what Paris and the SDGs mean. But on the other hand, it's pretty clear that we need regulation as well, that we need clear-cut regulation. You could see that our financial authorities are suddenly asking of how do you execute your fiduciary duties. So what are you doing, investors, to really dealing with the challenges of the Paris Agreement and sustainable development. And you see suddenly the focus, the lens of investors are changing. So you see suddenly a vibrant German federal system. Some lenders are just refocusing their investments towards green, and you see that happening. Is it happening quickly enough? No. Do we need to have more clarity and regulation? Yes, and that's why the debate which we are having here in Germany and in Europe, and I know that we're coming to back this later, is seeing. But you see a huge fundamental shift, and we're in the midst of it, and we are not at the speed, and sometimes we don't realize what's just happening, but we are on our way.
Excellent, thank you. Thank you very much, Karsten. So we're now going to move to the Netherlands, to Olaf. So Olaf, DNB is all about financial stability, and for a right reason. So how do you incorporate sustainability into your thinking, and how does that play with financial stability needs that are paramount to your central bank?
Yes, thank you. First of all, I think it was already there in our mission statement all along, but we did not really see it. Like many central banks in Europe, but all over the world, we are there to promote sustainable economic growth. And sustainable was being regarded as a low inflation environment. No booms, no busts in terms of economic cycles. And then we started to realize a couple of years ago that sustainable means something much broader. Mm-hmm. And indeed, the, let's say, potential perils of climate change for economic growth can be huge. So what we did, a couple of things. First of all, we started, as central banks are supposed to do so, we started to do some good analysis. What does climate change, energy transition mean for our economy, and in particular also for the Dutch financial sector, focusing mainly on the risks, but also on the opportunities. For the opportunities, we created a platform for sustainable finance, bringing together, let's say, banks, insurance companies, pension funds, investment firms, to exchange knowledge, information, but also to come up with a number of initiatives. There we are mainly the facilitator. And finally, climate change, energy transition, also in the domain of financial regulation, central banking, is an international issue. So together with 7 other central banks and supervisors, we have established the network on greening the financial system. It was established quite recently. Also, the Deutsche Bundesbank and BaFin are members of the network. Then we also have been pushing forward the issue of sustainability, indeed, in financial regulation. We are very happy from that point of view with the action plan published by the European Commission, which in many areas is going in the right direction. But, and you also see that, let's say, in terms of European financial regulation, the so-called European supervisory authorities are taking up this issue quite seriously. I'm a member here of the Board of Supervisors of the Insurance and Pensions Authority, EIOPA, here in Frankfurt, and it's really one of the strategic priorities. But we should go beyond. And I'm also a member of the Basel Committee on Banking Supervision, and admittedly, you know, especially in the area of banking regulation, we still need to really need to do a lot. And if you talk about climate change and energy transition, and I talk to many of my colleagues, they look at you with very big eyes. These guys have gone completely nuts. So a lot remains to be done, and I'm pretty sure that indeed it starts by adjusting, adapting financial regulators, regulations to also, let's say, help this transformation in the financial sector.
Thank you very much, Olaf. Just a thought on this. We are actually in the World Bank Group hosting Sustainable Banking Network, which is a group of 35 regulators from emerging markets. It would be wonderful to see how they can connect to your network of regulators in Europe and what can be learned on both sides. So moving on to Melissa. Melissa, we have heard a lot about fiduciary duties, both from Karsten and from Michael. And your bank, HSBC, has been one of the first ones to come up with the TCFD disclosure. It would be great to hear about your journey and why did you become one of the first banks to do this disclosure?
Hello, thank you, everyone. So I think the first thing I'd say we learned was that we have an awful lot to learn. So it was a very significant exercise to work behind the scenes with all of our teams across the various parts of HSBC to pull together the information for the TCFD reporting. People know HSBC as a bank, but we're also an asset manager, an insurer, a private bank, and a wealth manager. So the type of impacts are going to be different for each of those different divisions. So we had to come up with something which would be meaningful across the board. We had been accustomed to reporting at the Carbon Disclosure Project, CDP, for many years, but that was more about our own operations and our own footprint, whereas with TCFD, it's looking more towards our customers and the impacts of our investments. So getting the governance right around the TCFD hasn't been a problem. That was the easy bit. The challenges are really going to come later on when we start to think about scenario analysis, and it's not yet, we're not clear yet what that will entail. But I think the message we would give, it's better just to get started and get learning as you're doing. And there are trade organizations that should help across the various different sectors to get everyone on the TCFD reporting journey. Critically important for us as both a producer and a consumer of information. We need the TCFD reporting to enable us to make informed investment decisions on behalf of our clients and investors.
Great, thank you. Thank you very much, Melissa. So we're going to move to Joachim now, and what would be great to hear from you is both in terms of regulation. We have heard from Karsten and from others on the role of regulatory environment. And then in your organization, you work both in Europe and in the emerging markets. And we all know that if we were to make a difference in climate, we have to tackle the issue of emerging markets. So it would be great to hear from you both on the regulatory side, but also what can be applicable from Europe into the emerging markets.
Thank you so much for the question. So taking that maybe as a starting point where I would like to end up with my short comment. I think KfW, by tradition, we are here in Frankfurt since 1948, and we are doing international business since the early 60s. And we are rather, let me say, unique when it comes to development banks because we are doing the national business and we're doing the international business. So we financed a lot of the German energy transition. Till 2012, we financed more than 100 billion euros. And we're doing a lot on the international side just to scrunch some numbers. So last year, we did more than 30 billion when it comes to environmental financing projects. We did a lot on the climate side, close to 5 billion euros. So we are rather experienced when it comes to helping out for all these, let me say, financing issues where I believe that's not a proper crowding in of private capital. So we use a lot of, let me say, concepts that are, in my understanding, very innovative. We are using interest rate reductions. We are using other instruments. But at the end, and now I'm coming to my point, I believe, and it's the reason why we are here, at the end it is not enough what the financial industry is doing. So when we really talk about coming from billion to trillions, I think it's far away from that. Just to give you another number, if you take the green bond market, KfW is issuing green bonds since 2014. The green bond market is just 1% of the overall market, just 1%. It's definitely not enough. And it was already said in the introduction of the panelists, I'm a former central banker. I was in central banking for 17 years. I was responsible for financial markets. I had a part-time responsibility for banking supervision. And I believe, maybe it's too prerogative, but I believe we have to change the financial sector at all when we want to have a significant sustainable impact when it comes to the financing strategies of the banks. What do I mean with that is that if you take, for example, the portfolio of a bank and we come to climate financing at the moment, the perception of climate financing is that it's maybe just a kind of a reputational risk. It's not more, it's just a reputational risk. And this will not change the financing strategy of a bank in a long-term perspective. We have to come to the point where not having enough climate financing is perceived as an economic risk. And we are not there. So what is necessary is that we have to change, and I have to say that, we have to change the regulatory framework. So we are talking about Basel IV, but I believe we have to talk about Basel V. So Basel V, in my understanding, has to include the SDG goals. So a significant share of each balance sheet of a bank has to be invested in climate financing. If that is not the case, I promise you the impact of what we can achieve will not be enough. And so I really share the view of Mark Carney when he said, we are talking about things we're doing at the moment, and the impact is for the next generation. So we have to talk about the horizon, and we cannot achieve the proper horizon without a proper regulatory framework.
Joachim, that's a great call to action, and I think it needs a round of applause. We've got a proposal for Basel V alignment with SDGs. This is wonderful. So I'm going to ask you, Karsten, what do you think about that? What do you think about the role of regulation? And especially, what are your views on the recent efforts by the Commission, by the European Commission, to green the financial markets through a set of regulatory requirements?
First, I have to say that I fully agree with the statement that we need more regulation if we are serious. Second, how do we get there? If you look, and Michael is a member of the high-level group and preparing the Commission proposals, we take a dual approach. The first one is to give out a helping hand, clear proposals of what we used to call taxonomy, so that we understand better what green is. And you're absolutely right, green needs to be at the heart of economic decision-making. If it's not perceived as an economic risk, we will not achieve the transformation we need to undergo. The second one is, yes, and that is a soft approach as well, that regulators, financial authorities really need to have a clear mandate that they need to look into long-term sustainability and policy coherence with what we all signed as well. So far, at least interpretation of the mandate, you said it's already there, but it's not there in all countries. It needs to be clarified. And then the third element is clear-cut regulation that you need really to reshift the incentives within the regulatory system towards the investments we want. And that is not just the green sector. I think we're missing the point if we are arguing about the 1% of green bonds nowadays, but we need to look at the whole field of what some of us call brown. So it is that these investments are aligned with the overarching policy goals. And therefore, there is lots of talk about the green supporting factor, whether it's a wise approach just to take just a discount from normal risk assessments. I have my doubts. But on the other hand, I think it's much more that you penalize investments which we don't want. So it's a brown penalizing factor, which probably describes it more. But at least if you look at the requirements at the current system, long-term green investments is not favored. I think we need to focus much more on infrastructure investments. If you see what the G20 are doing this year, we have a debate on sustainable finance and one on infrastructure investment to getting money into some markets which are desperately looking for private investment. If we don't combine these two agendas, I think we are lost, because it's long-term infrastructure with, and I think there is a huge possibility for shifting financing into green infrastructure with good interest rates, and so get to that. We tried that our G20 presidency, and I think we got the macroeconomic message right, but now again coming back to lost in translation, we translate that into concrete regulatory action.
Great. So before we go to Olaf, because I know Olaf has a view or views on the green supporting factor, I would like to ask our buzzmaster if you can help us. What I'd love to hear from the audience, if is whether we should go for carrots or sticks. Karsten was talking about incentivizing the banks to finance green, or, which would be carrots, or disincentivizing the banks from financing brown, which would be sticks. Can we have a quick carrots or sticks and see what you guys have to say? And I have to stand up so I can actually see the carrots or sticks. Can we just do carrot sticks?
Both.
Can we do that? Okay? No? Yet? No? Get your phones. Tell us if we should incentivize through carrots or sticks. Both carrots. Come on.
Yeah.
Give us one. Give us one. Come on. Carrots, yes. Oh, sticks. Both people. Fine sticks. Oh, fine sticks. Right. Okay. Sticks, carrots, sticks. I don't think we have an emergence of one or the other. Okay. Okay. Well, I think we end up with both. So, Olaf, I know you have views on that. Carrots, sticks, or none? Or financial stability?
It starts with, it was already mentioned, it starts with a good taxonomy. What is green and what is brown? And actually that's also what the European Commission is proposing. That in itself is already a complicated discussion, but let's not make it too complicated. You should just agree on something. I learned that in China they did something similar, and it only took them 6 months to come up with something. So
right. 60% both, 30% sticks, 10% carrots, in case you want to be guided
exactly,
by
because you, before you start using carrots or sticks, you have to know, let's say, when to use it and where to use it. Now, capital requirements for banks, but it's the same for insurance companies, they bite depending on the risks. They're risk-based. So the higher the risks you take as a financial institution, the higher the capital requirements. The idea behind this so-called green supporting factor is that you lower the capital requirements when you start to increase your green exposure. But there we say, yeah, but what's the link with risks? Because we do not really know, we're not sure yet whether green exposures are indeed less risky. So we have some doubts about that, also because a lot of the evidence is still lacking. If you talk about the brown penalizing factor, which basically means you have to punish, in a way, the exposures to, let's say, fossil fuel intensive sectors, then at least you can say the evidence that those are more risky, think about the carbon bubble and those kinds of things, is probably larger. So if I would have to choose between those two, I would choose for the brown penalizing factor and not for the green supporting factor.
Rather than incentivizing the banks to finance
exactly,
green.
Yeah.
So Joachim, you've got views on that?
I believe personally that it is even more complicated. It's not just about carrot sticks and doing both. I think it's definitely not enough because we need a holistic understanding of the whole problem. It's not just the financial sector. I'm very sure that the financial sector has to change and we need some outside pressure because from the financial crisis we all know, and it's not just bashing the financial sector, it's how banks are working. That are not kind of institution where you have this intrinsic motivation to do something if there is not the economic pain. I think we need a kind of an economic pain. This is one side of the coin. The other side of the coin, we are doing business in countries where we often have to do it with dysfunctional countries, dysfunctional institutions, no existing financial markets. So this is what I mean with a holistic understanding of what is really necessary. So these countries are often overwhelmed with our expectations what they should do. So we really have to help them and give them maybe the proper setting, what is necessary, so that they can also do their part that is necessary to achieve the goals. Just to give you one example, most countries in Africa, or the banks in most countries in Africa, if you look at the portfolios of the local banks, what are these banks doing? They are buying government bonds of the respective countries. So often we have to do it with a credit crunch situation in most of these countries. So there is no, let me say, intrinsic motivation of banks to do financing in climate projects. It's not the case. So that is what I would like to see, that we have that holistic understanding, what is necessary from the financial sector here, and what we are doing as development banks to support these countries, to bring them into, let me say, the situation or in the in that they really, it's a kind of an empowerment of these countries to give them the proper instruments that they can do their part when it comes to financing climate projects.
Carrot, sticks, plus. So let us now go to the demand side. So I'm going to turn to Melissa and to Michael. So in order for all this to function, you have to have a demand on the other side. Somebody has to want green products. Somebody has to want that green mortgage. Somebody has to be able to buy that green bond. So I'd love to hear your views on the green bond market. We've seen it, 155 billion last year, but still just 1% of the global bond market. How do you see that being developed? And how do you see other financial products coming to the market? Melissa and then Michael.
So I think the first point I'd make is actually not so much green bonds, but I'd talk about investor duties, fiduciary duties, because it's all very well having commitment to making the transition to a low carbon economy, but if you feel that is outside of your remit and your mandate, it becomes very challenging for trustees and trustee boards to make decisions to allocate, for example, to the green bond market, which is small, reasonably illiquid, and relatively expensive. So I think what I'd like to see is not just a clarification that fiduciary duty includes taking into account material ESG issues, but also that asset owners, investment managers have some responsibility for addressing systemic risk, which is an industry we haven't been good at in the past.
So, sorry to interrupt here, but very clear that you need to have some sense of fiduciary duties on the side of the manager so that he or she actually buys these products because they believe that this is their fiduciary duty as opposed to just maximizing return.
Correct.
Now, the second question that I have to you, Melissa, is, as we said, if you want to make a difference in climate, you've got to do something in emerging markets because this is where it's happening. How do you incentivize managers to actually go beyond their 96% allocation to OECD markets and push them to go to emerging markets and to go green? What would that take?
I think if you look at what the blended finance task force is suggesting is we need better insight and understanding of the returns that are available from emerging market infrastructure investments, and that will entail the MDBs, DFIs disclosing some of their returns, risk return characteristics of their books. I think that would do a lot to give investors confidence, comfort that it's not as risky as they might.
Excellent. And we can talk about de-risking by the public sector, but I'd love to hear first from Michael. Demand for green products.
Yes. I'd like to reinforce the point on fiduciary duty because it's a very important one. Too many asset owners and asset managers still come up with an argument not to consider ESG factors by pointing towards their fiduciary duty, i.e. there is this notion of ESG criteria or taking ESG on board in my investment decisions could actually hamper my actual fiduciary duty of generating a risk-adjusted return. And this is simply plainly wrong. And that's why, as the high-level expert group, but also the EU Commission in its action plan, put forward proposals to actually clarify that this is not a contradiction. Academic research does actually show that it is not a contradiction. And in fact, I would go even one step further and say, taking ESG factors into account, taking a sustainability perspective when investing, it enhances your perspective on longer-term risk-return profiles. So this is very important. And actually, this week, the EU Commission is supposed to come out with legislative proposals around investor duties, clarifying it once and for all to asset owners and asset managers. On green bonds. There's a lot of talk about green bonds, of course, because it's a dynamic segment, but it is not the only instrument one should look at. it won't change the needle overall. It's infrastructure projects, it is equity investments. Similarly, even more so, you have to take, for long-term projects, there has to be someone who takes the risk. And this is typically equity capital, this is typically venture capital, this is illiquid, long-term, high-risk financing in some ways. And that needs to be incentivized in a way that actually investors who commit their capital make a return. You can't go from the billions to the trillions if investors don't see a return attached to it, or a better risk-adjusted return. So it could be that you, by taking ESG, avoiding brown, you can actually reduce your risk. That's one aspect of taking it on board and improving your risk-return profile. The other one is by enhancing your returns, by investing in promising yet risky long-term green projects. So it's the combination of the two, but it is this concept of more long-termism and enlarging the notion of risk by taking a wider perspective.
Olaf, any thoughts on this from a regulator and supervisor of banking institutions? Fiduciary duty, where does the fiduciary duty go, and what's your view on that?
I think that of course, in the end, financial institutions should, let's say, it should become an intrinsic part of their business. And we're not there yet. And a lot is happening, and I'm also absolutely convinced, I said that before, that regulation can help here, but it's not the only solution. Regulation is a framework for financial institutions in which they operate, but they also have a business model, and it should be part of the business model. And here in the end, I think, so governments can help, regulators can help, but in the end, it's also the consumers, the industry, that I think can make a big change and should also make the big change. And the good news is that indeed, at least in Europe, you can see there's a demand by consumers, there's a demand also by industry when it comes to approaching the financial sector in terms of products that they should change. So I think intrinsically the business model of the financial sector should change. And we're not there yet. There's too much still window dressing going on, as indeed was already said. You know, when it comes to sustainability, there's a department somewhere, sometimes very close to the CEO, etc., but it's still being regarded as, you know, if we do something in coal or whatever, it's part of a reputational risk, and we should do something, it's good for marketing, etc. But it's not enshrined yet in the day-to-day credit business of, let's say, the average bank. And that's what we should be aiming for. And again, as regulators, government, we can play a role, but in the end, it should come from the consumers and the industry. And luckily, it is changing.
So it's really about embedding it into day-to-day credit decision making.
Exactly. Yeah.
So tying up to that, we've got a couple of questions on from the audience about de-risking some of the investments so that we can grow financial flows to green projects. And as Michael mentioned, in some cases, green projects are already funded and very run-of-the-mill for banks to assess, such as a mainstream renewable, say, in Europe. But if you're going to, say, offshore wind, or if you're going to battery storage, or if you're going to any other more exotic area of green projects, that is really a venture capital type of space. And if not venture capital, at least private equity. It's not ready for the mainstream banking institutions. So what is it that public sector can do to de-risk that? And maybe I'll ask you, Karsten, to get us started on that.
I come to your question, but just on the carrots and sticks issue, the key is not just transparency and argue transparency of the financial system, but the real economy as well. And therefore, I think you need to combine both in order to do the transformation. The second one, if you look at both the economic and the fiscal system of today, you have huge information asymmetries. Many who have fiduciary duties are looking at what they are tasked or obliged to look at. And they don't have the capacities yet on that. So the question is, and then we come back to carrots and sticks. I argue, in the end, you would not describe exactly what the regulatory authorities or the investor need to do, but you oblige them to do that, because that, I think, would give a huge capacity boost, which we need. So what could the public sector do to help? I think we need to overcome the stigma that green is more onerous and more complicated. So there we come to what development banks could be doing, and we have done, but not at the scale needed. So providing guarantees, providing tiered funds where we, the public, take the high-risk shares in that. Because with that comes a lot of learning, and I think we are privileging that. We have been doing that with offshore wind. We have been doing that with other sectors, but that's only the first step, because in the end our resources are much too scarce that we could just shift the whole economy. But I think we are showcasing of what is possible. I think that goes as much to the traditional fields of investment, so in our regions, because most of our investment is still happening in China, Europe, North America, and other regions, but as well as enlarging to areas where we have difficulties to get private capital on the ground. So typical development banks field. But I think the point I would like to make, we need to have more risk appetite from the public sector and the public banks in order to create the room for the private sector to fill in the gaps which are crowded by the public sector banks so far.
So guarantees and other financial instruments, and in our own experience at the IFC, we are leveraging every public sector dollar that we get to $11 to $14 from the private sector.
Correct.
So you get your return on investment. Joachim, you ask for deeper regulation, more comprehensive regulation. What are the concrete policies that you would like to see, 2 or 3, that would really shift the landscape towards financing green?
Okay. Maybe in my understanding, if I would like to come back before I definitely would like to answer your question. I think this risk-return argument is a good, maybe brilliant argument. But banking per se is risky. Without risks, no return. So I think, looking a little bit beyond the horizon, I believe currently the banks are talking about business models. They're looking for business models. I believe that what is going on in Africa and in other regions, maybe is that a business model for the future? I see a lot of returns when it comes to climate financing, especially in these regions. I admit that at a certain point in time, I guess it is necessary to use taxpayers' money. But it's too easy for me, it's too simple to just saying, well, we need government support. We currently have, I guess, innovative products. I take, for example, structured products where the junior tranche is guaranteed by taxpayers' money. I think this is, let me say, a first mover reward if you want to invest in complicated projects, complicated countries where the risk is definitely higher. But I believe that the banking sector has to be a little bit more, let me say, proactive to do more. I think it's too easy to say that the risk-return profile is not right at the moment, but I guess it's super right in the future.
Thank you. So, Melissa, what do you think? You ask for disclosure by multilateral development banks in terms of returns so that you can articulate that for your investors and therefore move money into green and move money into emerging markets green. What do you think? What else would it take other than a disclosure?
Well, there's still, investor education is still a massive undertaking. And even within our own organization, you know, we have a lot of education requirements across the business. So rather than waiting for regulations to come through, what we've done is define our own standards for what we would sell or label as sustainably invested. So there's an HSBC sustainable investment label, so that we can try and make sure that we don't have greenwashing coming through our own organisation, and that our customers and investors will have some sort of quality assurance in what they're getting in the different styles of responsible investment, impact, ESG integration, etc. So I think that's something that we'd like to see in the marketplace as well. So principles-based global standards for investment products to be clearly agreed at a global level.
Michael, any thoughts on that? What else needs to be done other than the disclosure, other than the alignment of fiduciary responsibilities? What else?
Well, when I speak about the high-level expert group's final report and the action plan of the EU Commission built on it, I tend to try and cluster the recommendations into 3 areas, and I think they all need to come together. One is definition and standards as areas of action. So this is talking about taxonomy, talking about classification systems, standards and labels. The second one is culture and behavior. That's where fiduciary duty comes in, but not only fiduciary duty, also at the point of sale in many banks in Germany, the investment decision is made together with the client, in fact, with the retail client. And that's a big lever as well. That's not covered by fiduciary duty. The other thing is qualifications and requirements for people who work in the financial industry. They need to be stepped up such that ESG becomes an integral part. I'm also a member of the managing directors of the DVFA, which is the German Investment Society, Investment Professional Society. There in the curricula we built it in, and we demand from our profession, from professionals in the investment industry, we demand that ESG is integral part of their daily doing, and if you don't take it into account, you're actually not acting professionally. So culture and behavior can actually be influenced quite a bit by the supervisory dialogue. If your supervisor, the BaFin in Germany, asks you about sustainability as a member of a regulated investment firm, you will actually pay attention, and therefore I don't necessarily agree with the notion that we need more prescriptive or more regulation. We need a bit of different regulation. We need a concerted approach that has nudging effects as well. And the third element of action is transparency and achieving an impact, focusing on what we can actually achieve, i.e. we cannot manage what we don't measure, or we can only manage what we measure. Therefore, disclosure is actually important, but it has to go across the value chain. It can't be just the financial industry making more disclosures. In fact, the companies we invest in ought to disclose more so that we actually know what they are up to, what their scenario is, what their transition is, what their strategy is, and what their achievement overall is, for example, on CO2 emissions. We haven't got that. That's why we endorse in the high-level expert group, and I personally do it, the TCFD recommendations that build in scenario analysis. Because in the end, we have to achieve a goal, and we ought to measure it. So it's a bundle of actions that need to come together, and I would hate to just try and take one out and say this is the only one. That's why I'm so hesitant to go into that classification taxonomy discussion or green supportive versus brown supportive factor. That's good and well, and that's important. But we ought to take the whole bundle into account.
It's not that simple. Karsten, you have heard a lot of good ideas around this panel. Which one of those are you going to take forward for Germany to continue greening German financial sector, and what are the next steps that we will expect to see from Germany in this space?
I would agree with Michael that we need a whole host of measures, partly on the regulatory level and partly for building the capacities. And that's much more complex than just choosing one issue. So taxonomy is important. A clear-cut understanding of what the fiduciary responsibilities are is important. We will be getting concrete proposals on that one. I think we within the government need to be much more coherent as well on what we consider to be green or sustainable investment and giving stronger policy signals or translatory signals. But in the end, I think the financial sector has to ask one question. I think by all these measures, we will really reach that new emerging risks are better factored into the financial sector. So, but that's still a pretty passive role. Through regulation, you could make the financial sector an agent of change. And so far, I think the financial sector is not taking that responsibility. So then we ask, is it consumers and investors who ask the financial sector to take that risk? We come back to transparency, or we do that through regulation. I think that's where the debate is. But in the end, we need carrots and sticks, and we're driving that forward with the BaFin, with our institutions in Germany, but the main focus will be on just getting the regulation done within Europe within the next year, because it's an important window of opportunity. It will not reach all our targets by then, but I think it is just shifting gears considerably through implementing what the Commission will put forward this Wednesday.
It's quite a list of things for you to do when you come back to your office. So, last couple of minutes. Dear panelists, if there was one thing that you want the audience to remember when they walk out of here and say, we had this opening panel, these are the things they talked about. Joachim, why did you get us started? One thing that the audience should walk out of this room with from this panel.
I think the point I made, and I believe I was crystal clear here, that we need a tremendous change when it comes to the understanding of the financial sector regarding greener financing. And I think this is, for me, the conditio sine qua non. I think what we learned from so many, let me say, situations before, if you are not capable to change the financial sector to a certain direction, you will not get the impact you want to get at the end. And I think this is absolutely necessary. That's a starting point.
Change of financial sector and regulation. Melissa?
For me, it's clarification of investor duties, certainly across the trustees of pension schemes, but also those that look after retail and wealth client money, to ensure that systemic risk as well as material ESG factors are within those duties something you need to take into account.
Fiduciary duty clarification, very clear. Olaf?
I would also say full internalization of sustainability in the business model of the financial sector. And maybe, if I may add one thing, which we haven't discussed so far, but I think that's really key, not only for the financial sector, but for the economy as a whole, that is to internalize the pricing or the right pricing of CO2 in all our decisions. Because the big problem, the big issue is that the prices of CO2 emissions are too low. And that is influencing the whole market economy, also the financial sectors. So I think that's key. We have not addressed it so far, but I think this is the real issue. If the real price of CO2 becomes internalized in our market economy, I'm sure that the whole system will adapt to that. I think that's something which I wanted to add, because I think we have been kind of turning around that a little bit.
We've been going around it, and you're the first one to actually bring carbon pricing into this discussion, and thank you for that, because this is absolutely critical. And the second one is obviously moving sustainability out of that corner office and into the mainstream. Michael?
Well, I would like to encourage everyone not to just wait for what comes out of Brussels, what comes out of a taxonomy, what comes out of clarification of investor duties, but actually start where you are now, with maybe in an imperfect way, but with the same spirit that we talk about, to move actually words into action. And you don't have to wait for, we don't have to wait as an institution, we don't have to wait as Deka for the European Commission to set out the roadmap. It helps to give orientation, but it is amongst all of us individually to actually make a start where we work, where we are in the institution, then the players we have.
Time is now. And Karsten, last word.
It's about empowering our societies to change through radical transparency.
Radical transparency. With this, thank you very much, and big round of applause to the panel. Thank you.
Thank you so much. Panel, sit down. You have been so engaging. The audience have been asking you questions for your entire panel. So sit there. Michael,
Yes.
what do people want to know?
Well, we have a number of questions on policy, lots on banking, and a couple of awareness. And I would just like to throw this one out there. Practically, and keep your answers short, panel, please. Could we have Buzzmaster back on the screen? Hello, Tech. Marco. Oh, yes, thank you. Practically, how does the panel suggest that the bank changes its traditional view and invests in riskier projects? You have 25 seconds.
Bankers on a panel. Michael, Melissa.
All right.
Bank.
Maybe Olaf.
I've got a question. How do you define a riskier project? Because if you're putting money into coal today compared to renewables, that would be, in my view, riskier as an investment. So, yeah.
Michael?
Well, it goes back to the notion of risk-adjusted return. If you have a riskier project, you want to have a higher return for it. That will not go away as a general rule, because you have to put capital, equity capital, underlying the project. So it ought to have incentives, and the incentive could be a return, or someone who reduces the risk, as we talked about in terms of crowding in effects, first loss assumptions, and so on.
Okay.
Okay,
But
great.
maybe-
We have two about awareness, and
we
it's
have one
and it's
response from Joachim, if we can.
Maybe I do have to come back to that question, because I believe maybe the question is not right. Because I thought the purpose of a bank is to invest in riskier projects. And we will talk about the next days a lot about tech. If the banks are not doing that, then maybe others will do it. So this is a question of, let me say, how to survive as a bank in the future. I think we are in a changing financial environment. And I think this is something that is the question of the existence of a bank. What will they do in the future when it comes to investments in green financing projects? I think this is of a detriment. It's a most important question I would like to being answered as a CEO of a bank. What is my strategy as a bank when it comes to green financing?
Excellent.
thanks.
Michael, is there another?
Yeah, there are two questions
High-value
about
question.
awareness, and green climate financial products needs to be better understood by consumers in order to generate demand. What would you recommend to address this? That's one, and a part B to that is, what are the hurdles you encounter as a bank when it comes to better understanding and creating awareness?
Better understanding of green financial products. I think we touched upon it a little bit on transparency, but maybe there's something else you want to add, Michael or Melissa?
Well, it's not only transparency. It's this point I made with regard to the point of sale at a bank when the retail client comes in and asks for advice. In the UK, you've got independent financial advisors to do that, but in Germany, for example, and on the continent, overall, it's more at the bank's the bank's advisor level, and there needs to be more understanding. I think that's something where product providers like asset managers can do a lot more, but it's also about the training, and it's also about regulation in the sense that the focus on the ESG preferences, trying to gauge what the client actually would like to see when investing over and above the risk and return considerations, needs to be done more effectively. And to that effect, in fact, the high-level expert group, as well as the EU action plan, has recommendations and proposals to adapt the so-called suitability test in giving financial advice under MiFID II to give ESG questions a much more, and so sustainability preferences, a much more prominent role. So this is one lever, but it's also about educating and enhancing the qualifications of those that give investment advice. I think that's important.
Okay, thank you, Michael.
That's why we have networks, so that you can actually network and talk to our panel. Alzbeta panel, great job. Thank you so much.
Thank you.
Appreciate it. Thank you.